Hello, this is Chuck Stull looking at the basic economics of crude oil. So let's return to the first days of production, exploration and extraction of crude oil. Crude oil is an exhaustible natural resource. That means that as we use it, it depletes the remaining supplies. So with any non-renewable resource, the question becomes, when should we use it? Should we use the resource now, or should we save it and use it later? Or more broadly, how fast should an exhaustible resource be used? Right? So there's a trade-off. Oil used now is not available at a later date. Essentially, what we want to do is use oil when it is most highly valued. And to do that, we would look at the relative price. And we would use oil now if it is more valued now, and save it for later if it is more valued in the future. The goal is to extract oil in order to maximize its total value. And this would be known as the optimal path. Essentially, we don't want to extract it too quickly because that would decrease the current price, but not too slowly because we'd be giving up too much value by waiting. There are formal mathematical treatments of this in resource economics texts, looking at maximizing the discounted present value of the stream of revenues from a non-renewable resource. Let me look at a problem that can push us off the optimal path. And this is known as the common pool problem. Under US law, oil is regulated by the rule of capture, or the rule of first possession. So what the rule of capture means is whoever pumps the oil gets it. And so we often have oil reserves that are spread over miles and miles of land, and the surface land is owned by different people. And in that case, there can be a race to extract the oil before the neighbors can take it. This is inefficient in many ways. The photo here is from some land that turned out to have oil underneath it that had been already sold off for individual homes, and you can see each homeowner, each property owner, was drilling for oil on their own, trying to race their neighbors. This was an extreme example, but the general problem is that we would have overinvestment in drilling and production, which is an inefficient use of our capital resources. Oil will be brought to the market too rapidly, so faster than the optimal path. That means that the current supply will be higher and the current price lower, but we will have faster depletion, so we will have higher prices in the future. So the rule of capture depletes the reserves of oil more quickly than it should. It lowers current prices and raises future prices. In addition, oil, for the most part, isn't literally pumped out of the ground. The pressure from the gas in the oil, underground oil, causes the oil to flow outward. And so the picture here shows a gusher, which was an out-of-control release of pressure, and certainly undesirable. But the general idea is if you have more and more wells drilled in, you will lower the pressure more quickly, and that means that you will be able to recover less oil. There will be more oil left in the ground. Now, that oil can be extracted using higher cost technologies that repressurize the well, but again, those are more expensive and inefficient. So let me turn to oil policy. And oil policy in the United States changed substantially during the 20th century. Now, the early policy reflected concerns for oil producers, much like agriculture policy was concerned about the farmers. But recently, concerns have been about access to resources. But let me start with the Depression-era policy. During the Depression, the United States was the largest oil producer, and most of the oil produced here was most of the oil we consumed was domestically produced. Now, in the 1930s, there was concern that oil prices were too low to sustain the oil producers. This was partly because the Depression reduced the demand for oil as income falls. People demand less oil. But there was also new discoveries of oil and technological advances that increased the supply. And the price of oil dropped from $1.27 a barrel to 65 cents a barrel from 1929 to 1931. So it was a major slump for the oil industry, and there was an appeal to the government for help. Now, initially, there was state regulation. The Texas Railroad Commission looked to restrict output and to increase prices. The producers, just like the cartel example we talked about earlier, cheated and increased their production and smuggled oil out of Texas that was known as hot oil. And that led to the first federal regulation, which was outlawing hot oil, essentially enforcing the state rules. So the Depression-era policy was designed to increase prices, but it was also a policy that explicitly favored the small producers. So there were certain kinds of wells, stripper wells, that were exempted, and even though they had higher costs, it was essentially looked at as a way to support small businesses. And so we had a decrease in output from the efficient producers and an increase in production from the least efficient sources. Another policy that continued even after the Depression was a depletion allowance, which was a special tax break for oil producers that encouraged new development. Another policy that was very important, and that came in really after the Depression, was to restrict imports. So these would be the same kind of restrictions we talked about when we talked about agricultural international policy. But starting in the late 50s, as foreign sources of oil were becoming more important, it had lower costs than U.S. producers. The U.S. put restrictions on imports, which led to higher prices for the U.S. producers. Now, the overall impact of U.S. policy was to deplete U.S. sources of oil. Again, oil is a non-renewable resource or an exhaustible resource. And as income grew and as transportation changed during the 20th century, specifically with the growth of the automobile, the demand for oil increased dramatically. By the early 1970s, there were real concerns about having enough oil to keep the country running, and those import restrictions that had been imposed earlier were dropped. Most of the oil was imported by the oil majors, the multinational oil companies led by U.S. firms, and a growing proportion of oil came from the Middle East, who had big accessible reserves. And we'll come back to the Middle Eastern oil in another presentation. So if we look at what happened over time, the top graph, it shows the domestic oil production here in the U.S., and you can see that domestic oil production increased fairly steadily from 1920 to 1970, and then after that, domestic production decreased. As domestic production decreased, the U.S. came more and more heavily to rely on imports from other countries. And you can see the bottom graph, starting in 1970, a steep increase in imports. There's a drop there that we'll mention in the late 70s when we talk about OPEC and the oil crisis. And then after recovery from that, you can see that we continued to increase our reliance on international oil. So the imports went up from the mid 80s through the 90s and into the 2000s. So over the last several decades, U.S. main concern has been getting access to more oil reserves, to more oil resources. So that has led to increased offshore drilling, to developing oil resources in the wilderness areas of Alaska, and of course to have more and more access to international oil, and perhaps some of the military intervention we have seen in some countries is to continue getting access to oil. Now, there is a recent technological change that was really important and changed dramatically U.S. oil production. So this is horizontal drilling and hydraulic fracturing, often referred to as fracking. The idea here is that by pressurizing wells with water, the shale which holds the oil reserves will crack up from the tightly bound rock formations and releasing the oil, which can then be pumped up. Now, there are significant environmental concerns about fracking, but in terms of oil production, this is a remarkably effective technology at increasing output. So if we look in recent years, U.S. oil production, which had peaked in 1970, had been dropping fairly steadily through then. With the development of fracking, we had a really rapid increase in oil production, and the U.S. Even became completely independent of net oil imports. We were able to produce all of our needs, and we imported a little bit and exported a little bit that were essentially in balance. This has been Chuck Stull looking at the economics of the oil industry. Thank you.